Okay, great. Well, thanks for having me here, David. Great to be here. Welcome to all of you. Thanks for joining. A lot of great stuff to cover today in our session. I'm going to be revealing my golden one-day options trade. These are power play strategies for volatile markets. A timely topic, I think, is we've just gone through a major election and there's a lot of market uncertainty. We're in high inflationary environments. We have major FOMC meetings coming up. So we're going to talk a little bit about volatility and some actionable strategies you can use add to your trading arsenal to trade around these events. So before I do that, I'll read you a quick disclaimer. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options and must meet suitability requirements. We will be going over some various results on our session today, and I do my very best to share real world, real money results. So I actually will be sharing personal real money results out of my own brokerage account, and in particular related to the strategy that we're going to cover today, the golden one-day options trade. But just know that any of these results that I share, while they might be based on actual trades, due to the time-critical nature of trading, activity of other traders, subscribers, brokerage fees, etc., we don't guarantee that anyone will mirror that performance. So by the end of our session, you're going to discover one trade setup that has the potential to profit regardless of whether the market goes up or down. And these opportunities occur on a regular basis with astounding reliability. So whether you're just starting out or maybe you've been trading for decades, you're a seasoned veteran, this is really must-have information for today's markets, again, as they become more volatile, more erratic, and less predictable, I think is safe to say. So one of the most difficult aspects of trading, of course, there's a lot of difficult aspects and factors as it relates to trading, is really accurately and consistently forecasting and timing market direction. Because if you imagine, if you could, with, let's just say hypothetically near certainty, know when and in which direction the market was going to go, it would be pretty difficult to fail. And it'd still be possible, but pretty difficult, right? So this is a real challenge that we face in our trading and investing. And I think this is a good way to demonstrate that. This is a equity market volatility tracker from the St. Louis Fed, looking at market volatility over the past year or so. And what it really emphasizes, number one, is that it's erratic, so it obviously makes pretty large swings. We're going to talk about volatility, contraction, and expansion. And also that it's upward trending, right? So over time, market volatility has tended to increase. All right. And volatility creates a lot of opportunity, but if you don't know how to trade around it, it also creates a lot of challenges. So what if you don't need to know whether a stock will go up or down, or when it will go up or down? Okay, so we're going to eliminate this difficulty on our session today with the golden one-day options trade. So what I'm going to give you today to make it easier is, number one, you'll discover the golden one-day options trade. So I'll walk you through the whole strategy, and back it all up with real world, real money results. I'll show you how to identify this setup, how to trade this setup, how to profit from the setup, how to apply this setup to any optionable security. Again, real world, real money trade examples, right? So I'm not just throwing something out there and asking you to trust me. I'm gonna back all of this up with real world, real money results, and also how you can get expert guidance in the live markets to do this for yourself. So there's a lot of great stuff to cover today. Before I get into all the fun stuff, I'll give you a quick background on myself. Again, I'm Jeff Tompkins. Great to have you guys all here. If you haven't attended any of my past educational events, I have over 2 decades now, well, actually coming up on 25 years of experience trading the stock options and futures markets. Received my professional training at Morgan Stanley as an intern back at the trade desk in the early 2000s. And about 9 years ago, founded Altos Trading, where I'm the chief investment strategist. We've rapidly grown to over 60,000 dedicated members in over 100 countries across the globe. I'm also a hedge fund manager, so I do manage money for my clients at Altos Capital. And I really enjoy and love trading education. So while I do manage money professionally, I continue to educate, and a lot of what I teach to aspiring traders are strategies that I deploy within my hedge fund, and I credit what I teach, and I don't hold anything back. I give you everything that I use myself, and credit a lot of that with the success of Altos Capital, which has never had a losing year since the fund was launched. And I'm also a keynote speaker and educator. So again, I mentioned I love to educate. This is me on the stage at one of the International Traders Expos. So that's a little bit about me. Now let's get into the fun stuff. So what if you could profit if the market goes up or down? Okay, so we call this a market neutral or non-directional strategy. So there's no special indicators needed with this. Okay, so you don't need a MACD, you don't need a Fibonacci, you don't need a stochastic, right? There's no complicated chart analysis. In fact, you can do this without even using a chart. We're going to be using purely using statistics. And don't worry, it's not complicated. It's very simple. But you don't have to guess trend direction. You don't have to time the market. There's no uncertainty when to take profits. And it's, again, as I mentioned, a proven strategy based on statistics. Okay. So statistically over the long run, we're really building it around that, right? So over the long run, statistically, what does the market do? Okay. And this is critical for building a positive expectancy in your trading results. In other words, over the long run, you have a statistical edge to make money. Now you're going to discover why volatility is one of the only leading indicators of impending trends, how to identify when markets may be primed for a big move, how to build a trade that can profit regardless of which way the market goes, how to set accurate profit targets with limited defined risk. Okay, so everything we'll cover in the golden one-day options trade has upfront defined risk. You're never going to go into a trade not knowing what your risk and what your reward is. I'll show you how to play smart money trades and a whole lot more. So we got a lot of really cool stuff to cover. Let's dig into it. Volatility. Okay. This is a kind of an important baseline understanding and knowledge to have as we get into the golden one day options trade. Now, volatility, there's different types of volatility, right? There's historical volatility, implied volatility, and specifically we're going to look at implied volatility, which when understood, when you understand what it is, the significance of it, and how it can be applied to markets, can be a very reliable forecasting tool. Okay, so again, implied volatility is really a forward-looking predictive indicator. And what it is the option market's forecast of future price movements. So it tells us with a high degree of accuracy how much an underlying asset's share price is expected to change by a future date. Okay, and this can be obtained on virtually any retail broker or charting, broker platform through the options chain. And we're going to look at some actual options chains momentarily. But it will tell us the exact number of points the market is forecasting the asset to move up or down. Now, it's not always, exactly spot on. It's not always perfect. But again, over the long run, it is highly reliable and it's critical information. In fact, highly underutilized. Again, we've seen over 60,000 students come through our doors, and a very, very small percentage of them utilize this information when placing trades. Even if you do not place an option, you don't trade in the options market, you don't place any options trades. This is still critical information for trading equities, ETFs, etc. Okay, so let's dig a little deeper into implied volatility in predicting the move. So implied volatility is a measure of how much the market expects the price of an asset to fluctuate in the future and is a key factor in determining the price of an options contract. Traders use implied volatility to gauge whether options are cheap or expensive and to determine the possible outcome of an options trade. Okay, so IV is influenced by supply and demand and the market's expectation of the amount of stock will move. And it tends to increase ahead of a major announcement or event and decrease after the event is passed. So we call that volatility crush. So for instance, if there's a company's quarterly earnings release, on the horizon, as we lead up to that event, implied volatility for that equity will go up. Once the event occurs, once the quarterly earnings have been announced, you'll see implied volatility drop off a cliff. Okay. So that'll be relevant. We'll get more into that. But in terms of interpreting it, So this is kind of my, there's some subjectivity here. This is my interpretation of applied volatility. And that is that on a scale from, number one, it's on a scale from 0 to 100. So um, I consider like an IV of 0 to 20 to be quite low, extremely low, right? 20 to 40 is pretty low. 40 to 50 is more in the medium range. 50 to 80 is moderately high. And above 80, I consider to be extremely high. Okay. Now, IV forecasts the expected move, up or down. Okay. So it doesn't give us directional information or forecast. Right? It just gives us the expected move in either direction by a specific date in the future. And it does so with remarkable accuracy. But as I mentioned, again, it's not perfect, but that's okay. The golden one-day options trade does not require it to be perfect. And as I mentioned also, it doesn't tell us the direction of the movement, right? So you can't necessarily, while it's important information to have even for directional trading, it's not going to solve the problem of which way is the market going to go. But it's very critical for a market neutral or non-directional strategy. Okay, so let's start looking at some option chains so I can kind of shed some light on this topic. So in terms of predicting the move, this is an option chain of the SPY, S&P 500 ETF. It's not a current chain. This is a past chain from earlier in October. And looking at the 1 day out in expiration, right? So the October 7th expiration. Okay, so what do we see here next to the expiration cycle? There's a percentage, 12.85%. So what that is, that's just an annualized volatility forecast for the SPY. So that's over 52 weeks. We're not actually going to use that, so we won't get too deep into the weeds on that one. What we are going to use is the number next to that, which in this case is plus or minus 3.98. So what does plus or minus 3.98 mean? That means that by October 7th, so this is 1 day prior, right? October 6th. By October 7th, 1 day later, the SPY is expected to move up or down by 3.98 points. Okay, so again, it's not a guarantee, it's not perfect, but it's very useful and critical information if you know how to use it to your advantage. Okay, so that's our expected move. All right. Another quick way to do this, it's unlikely it doesn't, but for any reason your broker platform doesn't provide that information, you can just add up the at the money straddle. So you just take the strike price that's closest to the current underlying share price, right? So in this case, on the SPY at the time was right around, is it 572.98? So right around 573. You take the 573 strike, add up both the put and the call at the offer price, and it's going to give you a very close estimation of that expected move. All right, so what do we do with this information? Well, we're going to apply this to a specific market neutral or non-directional strategy. So let's look at some examples of that so you understand what a non-directional strategy is. So here are a few examples, like an iron condor. Okay, so an iron condor is the combination of two vertical debits or credit spreads, right? So vertical call debit spread, vertical put debit spread, same expiration. Now, this strategy has potential for consistent gains, but it does carry high risk relative to the reward. So it has an unfavorable risk reward skew. In other words, you might, risk 5 times, 6 times, 7 times what your maximum profit potential is. Okay, so the strategy might be appropriate in certain circumstances, but we're not going to be using iron condors. All right. There's also iron butterflies. So this is a limited risk, limited reward strategy, which profits when the underlying asset stays within a narrow range. Okay. So with this strategy, you really do have to be pretty accurate on your timing as far as the underlying asset staying within a certain period of time within a very narrow range. So these can be challenging. Now there's short strangles. A short strangle has limited profit potential with unlimited directional risk, right? So you're selling a call, selling a put. And this strategy can experience heavy losses when markets make big moves. Okay. So what we want to do is take advantage of big moves. We don't care which way they go, but we don't want to face unlimited directional risk. So we're not going to use short strangles. What the golden one day options trade is going to utilize are long strangles. So long strangles have limited risk. They have unlimited profit potential, right? And you don't need to guess the trend direction, right? The market can go either way, right? But you can't just put these on and hope and pray they're going to work out. And that's what we're going to get into here shortly is how do we use a statistical edge and know when do we put these trades on, why do we put them on, and when do they have the highest probability of working out. Okay. So a long strangle, we'll talk a little bit about this. The mechanics of it is an option strategy where the trader buys a call at a higher strike price and a put at a lower strike price with the same expiration date and underlying asset. Okay. So a strangle is used when the trader believes the underlying asset will make a large price movement, but is unsure of the direction. And as I mentioned, the strategy is limited defined risk with unlimited profit potential to the upside and substantial profit potential to the downside. Now, you don't. It's not necessary to predict the trend direction, right? So that's kind of a weight off the shoulders. You're not having to try to predict the trend direction. Okay. Now, the trader can profit on a significant move up or down in the underlying asset. Okay, so you do want to have a significant move here. And if a strong directional move does not occur by expiration of the option contracts, the strategy can also be adjusted to mitigate risk and even generate a net profitable outcome. And I'm going to show you some ways to do that as well. Now, we're going to throw something else into the mix here. Zero-DTE. So that stands for 0 days to expiration. These are relatively new to the options market. In fact, in 2022, the Chicago Board of Options Exchange, CBOE, announced that it would issue weekly options with expiration days on each day of the week. Okay, so these are option contracts that exist for a single trading session and then expire on the same day that they are traded. Right. So, the S&Ps, the Nasdaq, it's very, very not only cool but useful that we now have daily expirations. And that's going to become clear why, because it gives us really critical information. Again, even if you're not trading options, if you're trading the underlying asset. Now, these have become increasingly popular. So according to the NYSE, 56% of retail options volume is in contracts with 5 or fewer days to expiration. So a huge percentage of the volume of daily option contracts is, is focused on these short dated or expiration cycles, which is very interesting. But that's good, right? Because it injects liquidity into the market, et cetera. Now, zero-DTE option prices are significantly impacted by short-term moves in the underlying security. We're going to talk about that, a little bit about gamma. But what this means is significant profit potential for those who know how to take advantage of it exists. And you're going to know how to take advantage of this very shortly. So I mentioned gamma. If you're not familiar with gamma, it's one of the option Greeks. And I'll just give you a high-level overview so you have a basic understanding of it. You don't need to use gamma per se in the golden one-day options trade. It's kind of automatically built in to our advantage. So this is for purposes of, background knowledge, for understanding. So what it is the rate of change for an options delta based on a single point move in the delta's price. Now, option gamma is a risk metric that measures how quickly an options delta changes in response to a $1 change in the price of the underlying asset. So for zero-DTE at the money options, gamma is at its peak, meaning that small changes in the underlying asset's price can lead to large changes in the options delta. So this is what I want you to understand, is that we're looking at short dated options, 0-DTE, 1-DTE, and taking non-directional long positions to take advantage of gamma. Okay. Now, gamma's the enemy of an option seller on a short dated option, right? So, or an option that's getting closer to expiration. It can have a very negative impact on an option seller. So and I do sell a lot of options, but that's something that is often overlooked amongst retail traders, and unfortunately kind of comes bites them in the ass at some point, and we're going to use this to our advantage. Okay, because it can benefit the savvy short-term trader who understands how to harness its power, right? And that's what the golden one-day options trade will do. So let's dig a little deeper now. Going back to implied volatility and predicting the move. Okay, so and the SPY options chain. So again, back on October 6th, the SPY was trading just below 573. Okay. We're going to look at the following day's expiration, October 7th. Okay, so we're looking at obviously very short dated option expiration cycles here. Now we've identified the implied move is 3.98. So the option market is expecting a move up or down in the SPY by October 7th, right? Up or down of just under 4 points. Okay. Now, step one, we're going to go through the strategy. Step one is to buy a call and a put with strikes near the outer edge of the implied move. Okay, so we're going to use that expected move number of 3.98 to select our strike prices on both the call and the put side. All right, so if we look at the calls, that would be, and we'll just round it up to 4. Again, this doesn't have to be precise, but we'll let's round that up to 4. We add that to the current underlying shares price of the SPY, and that would tell us to buy a 577 strike call. Okay. Now on the put side, so we would subtract from the current underlying share price, would tell us to buy a 569 put. Okay, so now we're placing our strikes at the outer edge of the implied move. So why are we doing that? Well, number one, these out of the money contracts are fairly inexpensive. You can see the 569 puts are bid at 65. The calls are bid at 26. So you could literally put this trade on for, around 100, under $100, around $100, right? Now, the other thing is that we know with a high percentage of the time that implied move is going to be reached. It may be exceeded, but it's a very small percentage of the time that it doesn't at least fulfill that expected move. Okay, so once we've identified our strikes, and let's say we put on a long strangle trade, we need to consider trade management. So defining our risk and reward. This is an important, critical step to any trading plan in building your trade. So as far as defining risk, we need to understand what our risk is prior to entering any trade. For a long strangle, the maximum potential loss is the premium that you pay for the contract. So there's no need to use stop losses. I mean, you certainly can if it's your personal trading style, your comfort level, your risk tolerance. But personally, I don't use stop losses with long strangles. I just define my risk up front. Whatever I invest in the trade is my maximum risk. Okay. That way, I don't have to try to guess where I should get out of the trade. In the event of an adverse move, or in the case of a long strangle, we don't get a sufficient directional move, right? So I know what my risk is. Now, the fun part, defining the reward. I look to target 50 to 100% return on capital with a long 1-DTE or 0-DTE long strangle. So we would simply add up the premium paid for the put and the call contracts to predefine our exit price. So again, you don't have to use any fancy indicators on a chart. You don't have to analyze support and resistance levels. You literally can just do a quick bit of math, right, and figure that out. So whatever you pay for the strangle, I define my risk, or my reward by 50% of the premium paid to a maximum of 100%. And there are methodologies that I also use where I'll scale out of position. So I may exit half the position at 100% ROI, and if expected move or implied volatility is increasing during the trading session, I may hold the second half of the position for what we call a runner or extended gains in the position. A little more of an advanced topic. Okay, so we've defined our risk and reward. Now, step 2 is to add the put and the call premium to determine our total risk, right? So if we add up the offer price, so we're gonna buy it, assuming we'll buy at the offer. Um, we add those up. Okay, so looking at the call side, we would pay 27 a contract. Put side 66 a contract gives us a total investment of $93 a contract. So you could literally put this trade on for $93 per contract. Okay. So these can be done in small accounts. But of course, you can scale this up to, again, your risk tolerance, your account size, etc. Now, to set our profit target, right? So once we've entered the trade, we want to set our profit goal and then add to the total premium paid for that strangle. So this is the basic math, right? So if we have a profit target goal of 100% ROI, so if we paid, $93 for the spread, and we want to double that, right? We would take that cost of the spread, 93, add it to the put premium. It's going to spit out a number of 1.59. Then we add that to the call premium, right? 1.86. So the reason I do it this way, why not just double the premium you paid, is because I typically like to enter separate orders. So I'll figure out on the call and the put side rather than just exit the whole strangle, because there are occasions when you have extreme market volatility and you can actually hit the profit target on both the call and the put side. And so in those cases, you may want to set different profit target or limit orders on either side of the spread, the call and the put side. But either approach works. You can exit the entire spread if you hit your profit target on either the call or the put side, or you can set separate limit orders, which is what I, again, typically like to do for the call and the put side. That way, while it's not a frequent occurrence, there are occasions in extreme market volatility where I've hit both the call and the put profit target levels. Okay, so now it's time to place your orders, right? So step 4, we submit our GTC. That's a good till cancel limit order for both the call and the put side of the strangle. Okay, so we set that at 186. Okay, so all we're looking for 100% ROI on this spread. And we're looking for the SPY to at least fulfill that expected move of just under 4 points up or down. Again, it doesn't matter, by the end of the following trading session on October 7th. All right, so let's see what happened. Which direction did the market go? It doesn't matter, right? What matters is that implied volatility increased and the expected move was reached or exceeded. And in this case, the SPY rotated lower just under 1%, 0.95%. Okay, so if we look at our put contracts, okay, number one, we exceeded the implied move. So the put contracts are now trading in the money. Okay. They easily hit our profit target. Easily. Right. And this is where, this is one reason I like to scale out of positions, because there's more profit potential in this trade. You have easily hit our profit target right at those 569 puts, okay, which reached a high in that trading session of 254. So that $93 net profit per contract, right? Again, this is totally scalable. Could equate to $930 on a 10 lot, right? Over $1,800 on a 20 lot. So all in a day. These can be incredible annualized return opportunities. You just need to know how to harness these. So I'm going to give you a couple tips here now. And these are important. So number one is avoiding volatility crush. I mentioned that earlier in our session. Okay, so volatility crush occurs after an anticipated event that results in contraction of price movement. And because implied volatility is a major component of option pricing, it can cause the options premium to decrease rapidly. So that is an enemy to the option buyer and to somebody who's trading a long strangle, right? So we want to try to avoid that. And sometimes we just get trapped in it. It can happen, but we want to obviously be aware of upcoming quarterly earnings releases, anything that might cause a volatility crush, because it can negatively impact the value of the calls and the puts in the strangle. And factually, long strangles benefit from an increase in volatility. So what we want to do is look to place these trades when we expect volatility to increase or remain high, right? So there's a number of ways to do that. You can actually look at the implied volatility statistics. You can even do this just by eyeballing a chart and the candlesticks, right? So I'll just show you a quick and dirty trick way to do this. And this is important. So volatility alternates between contraction and expansion always. So when you're in volatility contraction, it will at some point transition into volatility expansion, right? When you're in volatility expansion, it will then at some point alternate into contraction. Okay, so that can be visualized on a chart. So a narrow high-low range. So high-low range includes the wick of the candle. If you just look at the candlestick high and the low, right, indicates contraction. A wider high-low range, right, indicates volatility expansion. So again, we're just looking at the high and low of the candle. Okay, and as I mentioned, it is always alternating, right? So here we have volatility. You see that candle on the very left is relatively narrow compared to the red bearish candle to the right of it. So we're transitioning from volatility contraction to expansion. Okay, volatility contracts, then it expands, then it contracts and expands, contracts, expands, contracts, expands, contracts, expands, right? So that's how that works. So we, again, want to look at entering these in market scenarios where volatility is expected to at least remain steady or increase, okay? But there are occasions where you may get trapped in a volatility crush, right? So there's a way to deal with that. There's a number of ways, but I'll give you a strangle adjustment strategy, okay? A couple of them. So one option, so let's say we enter a long strangle, the market just doesn't fulfill that expected move. Its volatility is decreasing. Our call and put contracts both remain out of the money, and their expirations is approaching, and the premium is rapidly decaying. What we can do is we can sell premium. So basically convert this into a spread on both the call and the put side when the market doesn't move as expected. That can help mitigate losses. It can, in even some cases, result in a break even or even net profitable outcome. Another option is to convert to an iron fly, right? Or an iron condor to bring in premium to cover loss on the long call and long put when the market's flat and in volatility contraction. So an iron fly would just be, so you keep your long strangle strikes in place, and then you sell premium at the money strike on the, or midway between the call and the put strikes on both the call and the put side. Okay, so again, it brings in premium. And because the market's not moving, and that at the money strike price is going to have, higher levels of premium and will decay very rapidly as expiration approaches. It can again help mitigate losses and even in some case produce net profitable outcomes. So those are a couple ways to transform a losing strangle into a potential net profitable spread or to mitigate risk. Okay. Now, I've traded strangles, quite a bit in my option trading career, and I used to not incorporate expected move. Right, I just kind of did them blindly or just used like an arbitrary delta or whatnot. So using expected move and understanding how to apply it relative to implied volatility cycles can result in a very consistent strategy and results. So these are actual real world, real money results from my personal brokerage account, trading strangles on 0-DTE and 1-DTE options. Okay. We do this in our live trade room with our Altos members. Okay. And this is just a 1 week consecutive snapshot of my strangle trades. And I did these with small positions, obviously, just 2 contracts. I did 1 contract on that August 4th position. um, and did $3,900 in a week, just trading a couple contracts, okay, on the S&P. Okay, so I was only doing these on the S&P options. Yes, you can do them on equities, you can do them on ETFs. I really like to do strangles on index products, S&P, NASDAQ. You don't have to worry so much, about whether it's quarterly earnings or whatnot. Okay, but yeah, that can be done on individual equities as well. And they can be traded within small accounts, starting with as little as $500. In fact, I showed you that one example of the strangle that you literally could have done for $93, right? And of course, all scalable based on your risk tolerance and account size. Now, I have a major announcement to make. We recently launched our live trade room. This is something we've been talking about doing for ages. I don't know how many years. Had a lot of requests and demand from our members, and ultimately decided to, jump in and do it. And so we've launched the Altos Live Trade Room, which we hold sessions again during market hours, 11 a.m. Eastern time on Tuesdays and Thursdays. Okay, and I I trade during the session, so I trade my real money account. Okay, and you guys get to watch me place these trades. Now we don't just do strangles. We don't just even do options, right? We do equities. We trade ETFs. Again, we'll do other option strategies as well, futures, currencies. So we use a plethora of methodologies, strategy, asset classes to focus on what's appropriate for the current market environment, rather than trying to form fit one strategy for all market environments, which tends to not work well in the long run. So we do a lot in the trade room, okay? And I wanted to share one of our core strategies, the golden one-day options trade long strangle on Zero-DTE options with you on the session today. So we again do other asset classes, and whether you're just learning or you're an expert, you've been trading for a long time, and you want to learn new strategy, new approaches, you want to watch, and this is really a unique opportunity because I don't know of any other hedge fund manager who's going to let you watch place trades in his personal brokerage account. So you get to watch me trade, right? We do intraday trades. These are examples of, again, real world, real money trades in the futures market that I placed out of my Thinkorswim account on the E-mini S&Ps. You get to, if you want to learn, if you want to practice, you're under no obligation. We don't place any trades for you. That's entirely up to you, but you get to see what I'm doing. Not just with intraday trades, but also we do, more swing trade opportunities. Again, we don't form fit anything. So it's, there's a variety of methodologies, approaches, asset classes, and durations. So it includes both intraday trading or day trading and more swing trading opportunities. We also send trades out after market hours as well. So we'll talk a little bit about that. So equities. Here's a recent snapshot of, again, this is real world, real money, my personal brokerage account of equity trades. So we're going to be doing trades like this in the trade room as well. In fact, we've closed out some really nice equity trades in our trade room. All the equity trades we've closed out so far have been winners. And here's some examples. Again, I did these in my personal brokerage account, over $4,500 in about a week. So we'll be doing these types of trades as well. And again, no guarantee that any past performance will be replicated in future results, but I want to share with you, real world, real money results as it relates to the strategies that we utilize within the trade room. So now I'm going to make a promise to you. I want to help you guys have days just like these, and I'm going to give you access to trade alongside me. This is a one-time opportunity to join me to discover how I make consistent income in the markets day after day, week after week, and I reveal every one of my special techniques and indicators that make profits like this possible. So I don't hold anything back. I don't give you a redacted version of what I'm actually using or doing. You get full disclosure on everything, right? You get all the information, all the education, and all the tools. Okay, so that's going to include an annual membership to our Altos Live Trade Room. You get exact entry and exit signals for these trade opportunities. You get live interactive trade sessions. If you are not able to join a session for any reason, that's perfectly fine. Again, we do record these. We post them in our members area. We send them out after the session. If we place any trades, for instance, like for the next session, you'll be notified on that. If you have to, hop off early from a session, you can go back and review anything. All right. So it's all posted in our members area. And you get full support of personal coaching from me. Only limitation is I cannot give you personal individual advice. But I'm there to support you on an education basis. So these are interactive. You can ask questions and learn how I trade. Okay. These are all proven strategies, proven tools, proven education. Okay. Over 9 years at Altos, over 2 decades in my own personal experience, and Altos Capital, my hedge fund, never having a losing year since it was launched. Okay. So again, this is an opportunity to trade alongside professional hedge fund manager, learn how he operates in the markets, and cut the learning curve starting as early as tomorrow, right? Our next live trade room session will be tomorrow. So I'm going to let you guys know shortly how you can join that. But there's more in the package. Not only do you get exclusive annual access to the Altos Live Trade Room, that normally retails for just over $4,700 a year. Okay. That seems like a high price tag, and it's not going to be anywhere near that, trust me. But I think when you see the results, you'll see that it's worth it, right? And it includes a lot more. Real-time option alerts. So we'll be sending alerts out outside of the trade room as well. So you are going to get those from our proven track record of option selling strategies, right? Which we normally retail the membership at $9.97. On top of the 2 weekly live trade room sessions, you're also going to get Tuesday evening weekly coaching sessions. We hold those at 7 p.m. Eastern every week. Okay, you're going to get access to those as well. It's part of the package. I'm on those each week. We do market analysis, market overview, typically focus on a strategy each Tuesday evening like we did in our session today. I have a whole lot more. And then you also get exclusive invitation-only Facebook group access, right? To our private Facebook group of over 800 members now and growing. You're going to get our professional trading series online course. This is over 10 hours of content that goes through our top options, equities, ETF, currency strategies. And ultimately learn to trade equities, futures, ETFs, Forex, options, whatever market you like to trade, which obviously we can't put a price tag on, right? Now there's 2 bonuses in the package. Bonus number 1 is our price action pivot indicator. I'll give you a high level overview of that in just a minute, but you're also going to get our latest indicator, price action pivots. We normally retail that indicator for $9.87, as well as my latest e-course, how to win 97% of your options trades, which we normally retail for $3.97. This is one of our core option selling strategies, which actually has a higher net win rate than that. We've, I think, closed out somewhere around 385 option selling campaigns with net profitable outcomes. And we have currently 2, maybe 3 open in adjustment. Okay. Now the total value on this package is over $10,000. Okay. We're slashing this big time for the event today, 65% off, $297 a month, right? And we're only going to open this up at 25 seats because we do have limitations on our room. So we can only have so many members in there, and it does cap out. And also we want to make sure everybody's getting the service and education they deserve. And that would be sacrificed if we have, hundreds and hundreds of people in the trade room at one time. So if you want to claim one of the 25 seats at the 65% discount, the link is altostrading.com/LTR. It's for live trade room. altostrading.com/LTR for the 65% off. Now, I mentioned you also get bonus number one, which is a $997 value. It's our latest indicator, the price action pivot indicator, which we'll be utilizing in the trade room as well. This is available on TradingView. If you don't have a TradingView account, it's just an online charting platform. You can set up a free account and begin using our indicator, which identifies critical pivot points in the market and forecast directional movement. It accurately identifies key turning points in the asset, right? So we use a unique pivot point formula. And I also, we have education around that as well. You can actually, if you don't decide to use the indicator, we can teach you how to spot these. It's just a lot easier to use the indicator. But it gives us a unique pivot point analysis that helps confirm a valid pivot and then forecast the short-term and long-term trends, right? And that can be applied to any asset class. Again, equities, ETFs, futures, Forex. You can use it on any time frame. We have a pro version, which you're actually going to get. You're going to get the pro version of this indicator that allows you to define your own parameters. So we have a lot of user-defined parameters. So you can adjust, for instance, like your risk-reward levels, et cetera, in that indicator. So that's one of the features you'll get. I love using price action pivots for directional options trading. So, if I'm going to take a bullish or bearish position, buy a call, buy a put, vertical call, vertical put debit spread, whatever it is, this is where timing becomes critical. And the pivots can really help, hone in on your timing for directional moves in the underlying asset. So that's a useful approach with the price action pivot indicator, and it helps us remove the guesswork. Right? So we're not guessing, whether there's a valid pivot and whether the market is likely to reverse or, continue directionally, right? In other words, like a trend continuation. So it helps remove a lot of that guesswork. Now, as I mentioned, it's available on TradingView. We're continuously rolling it out to other charting platforms. In fact, we recently rolled it out as well to Wealth Charts. So if you're a Wealth Charts member, you can also get it on Wealth Charts. And you'll also get bonus number two. Again, this is the e-course. This will be in your members area, so you can watch it at your leisure. All the modules will be in there when you log in. And this is, again, one of our core option selling strategies for consistent option selling results. That is also included. So we get hundreds, if not thousands, of testimonials from our members at Altos. I'll share a few, some of those. I'll just go through one from one of our dear members of Manchu, who told me that I was so on the money about SPX expectation today that he placed a 0-DTE put trade at 10 a.m. California time and was out at 1 California time when the market closed. His options expired and it was successful. Okay, so these are some of the types of strategies we'll be using within the trade room. So we get many testimonials from our dear members at Altos. And really, it only takes potentially one winning trade to pay for your annual membership to the live trade room. And there is an annual option as well. If you guys prefer to save more than 65%, we do have an annual option. You can go with the monthly option. It's totally up to you. But either way, there's no contracts. There's no commitments. We never raise the price on you. So once you're locked in at that discount, it's yours for as long as you want it to be. Okay. And we also have a guarantee. So if you don't at least make your membership fee back in the first 90 days, we'll give you an extra year of trade room access on the house. Okay. The retail value for that normally is over $4,700 for the year. So we'll give you an extra year on the house. Even if you don't trade, that's fine. And really, I encourage you to always, with anything, to paper trade it. right? Get comfortable with any new approach, any new strategy. Uh, and so even if that's the case, just shoot us an email, let us know, and we'll comp you an extra year. All right, so I'm going to open it up to questions. And I also want to give you our contact information. You can email us at support@altostrading.com or call us toll free 800-895-9348. I always say toll free. I don't think that matters anymore. I don't think anyone pays a toll. That I guess reveals my age a little bit. But in any case, 800-895-9348. Again, altostrading.com/LTR. Once again, here's everything that comes within the package at that 65% discount. Again, that monthly option will save you 65% over the course of the year. You can save even more than that if you decide to join as an annual member. And again, it is limited. So if you want to receive that discount, please don't hesitate. Let's see. I'll go ahead. If you guys have questions and want to put those in the chat, I will peruse the chat here and see. Jan's asking for how many months? Yeah, Jan. So there again, no contracts or commitments. You are free to remain a member as long as you please. So that is totally up to you. But again, there is that annual option if you want to lock in a bigger discount for the entire year. Looks like David put that link for you guys in the chat again here, along with our contact information. Let's see, just kind of perusing here and see if there's anything else. Yeah, so we will be utilizing, again, a variety of strategies. I shared one of our core strategies, the Golden One Day Options Trade, long strangles. There are other option strategies we'll utilize. There are, again, equities, ETFs. We may do some Forex or currencies. We'll do futures. In fact, we've recently placed some nice quick intraday futures trades in our sessions last week, booked profits on those. Let's see. Blue's asking, would like to start after a certain date. Blue, if I'm understanding you correctly, you maybe aren't prepared to join at the moment, but want to join later. Yeah, that's fine, Blue. If you would shoot us an email, here, I'll throw up our contact info again. Just let us know that you were on the presentation and that you want to lock in one of those seats. That way we'll honor the discount. Let's see. Do I walk through live trades step by step? Yes, good question. So I won't just be sitting there placing a trade and, in silence. So any move that I make within my account, I'm explaining the rationale for it, the mechanics for the trade itself, right? So showing you how I'm setting the order up in my broker account, because these are going to be done through, an online screen sharing session. So you actually see everything I'm doing, but not only do you see it, you'll hear all the rationale for it, and I'll be teaching the strategies behind it. So there's a huge amount of education that comes along with it. It's not just watch and copy type of scenario. So good question there. Let's see. Okay, but yeah, traveling for the holidays, totally understand. Yeah, we'll work with you on that. Appreciate it. Let's see, if we miss a session, do we see a recording or a summary of the session? Yeah. So again, the recordings will be placed in the members area following the completion of each live trade room session. And then we'll also email you out a link where you can just link right over and watch anything that you may have missed if you had to join later, hop off early, or if you just weren't able to join that day at all, that's fine. And then if we place any trades within the room that day, we provide a recap of those in the email, and any trades that we'll be placing for the following trading session. So like on one of our Tuesday sessions, if we're, we won't be meeting again until Thursday, and we're going to place a trade on Wednesday, that'll also come out on the email with all the instructions, etc. So you'll also get opportunities outside of the live trade room as well. And a lot of our trade room members, don't join every single session. That's perfectly fine. Good question. Let's see if we have any others here. I just want to throw throw the package up again here. Again, over $10,000 in retail value. Huge discount on this, and a lot of education, a lot of value that comes along with it. It looks like I have covered all the questions that I'm seeing. So I just really want to thank all of you for being here. I hope you got a lot out of it. I hope the Golden One Day options trade is a valuable addition to your trading arsenal. And really want to thank David for having me. And just had one last question pop in, then I'll pass it back over regarding typical selling strategy. I'm assuming that is a question of, do we sell options and what is the typical strategy we use? The answer is yes, we do option selling strategies as well, utilizing, for instance, spreads, so vertical spreads, credit spreads, iron condors, selling put premium. So yes, there are a variety of option selling strategies as well. Hopefully that was the direct answer to that question. Okay, well, once again, thanks so much, David. I'll go ahead and pass it back to you. And welcome to all of our new members. Looking forward to seeing you in tomorrow's live trade room session.